Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts to Chat for March 2nd of 2025. Good to be with you again this week. We've got a lot of data to cover, so let's jump right into it. We have current estimates for growth as well as inflation, and so here we look at this chart up here. This is for the 2025 current estimate as per Bloomberg for the GDP growth rate. And what we see here, the latest number in that survey is 2.3%. You can see October was really kind of that trough, and we were kind of anchored in the 25 estimate for a long time, and then we've accelerated. And what's be interesting to see here is with the specter of tariffs and other types of risks that seem to fit on the horizon here, whether this number is going to stay up here. And so then we travel down here. This is household consumption, looking at about 2.7%. We know consumption's been relatively strong. Again, very similar chart in the sense that October seemed to be kind of that launching point just before the election. And we've got a lot of confidence riding right now on household consumption. And 2.7, by the way, is a really good number. Then we jump over to inflation, and so that's also an issue. And I think these two areas, or these three areas, I should say, they're all related, and it's interesting to see them all move in the same direction because as far as CPI goes, the current estimate is 2.8%. You can see how that has come up quite a bit, and a lot of this has to do with tariffs, and we know all that. We've talked about that ad nauseum, but tariffs, at least in the short run, drive inflation, and overall price bucket, as we'll see here in a little bit, is not conducive. The landscape is not conducive to really more than one rate cut here in 2025 as it stands today. Again, that could change. So this is CPI. This is core PCE. So a very more narrow measure of a inflation reading that the Fed spends a lot of time looking at. You can see that that's 2.6, also directionally changed quite a bit in relatively short period of time. Now we have average hourly earnings, which, as I said, on numerous occasions, is one of those key components of inflation. And we do have sticky wages, and we can see here that the estimate now for 3.8% seems to have increased. And labor markets, by and large, are pretty stable. We're going to look at that in just a second. But bottom line here is that we've got sticky wages, and I think that's going to keep not only inflation, above this supposed 2% target. And honestly, I think the Fed's going to acquiesce at some point and say that, well, can't really hit 2 without having a recession. So really the baseline right now is probably 2.5 to 3%. And I fully expect them to come out and acknowledge that at some point. And as a result of various items, fear, what we just looked at, expected inflation increasing, and so on and so forth, that the expectations for rate cuts this year have gone down. You can see, like, in a relatively short period of time, that consensus has changed. Not only, this is the actual rate band, and of course we started having rate cuts back in September, and we've been on hold for a couple months, a couple meetings now. And so now the estimate, the gap between expectations and where we are now, is only about 42 basis points, or 42/100%, which is less than 2 25 basis point cuts, which we have seen here. This is a 50 basis point, but these last two were 25 basis points. So basically what this tells us then, to reiterate what I said a couple slides ago, is that the expectation that we saw coming into the year of multiple rate cuts, that's dwindled down to basically one and maybe a second rate cut at some point. But I would submit that there's a case to be made that rates don't get cut at all this year, and some are beginning to try to make a case that rates maybe will go up this year. But I think too early to tell on that, but just suffice it to say, I think we've got higher rates for longer staring us in the face. Here we have some minutes of transcripts in earnings reports, and you see here in the blue bars it says mentions of inflation. So obviously when we had peak inflation back here, this is CPI, Consumer Price Index year over year. Peak inflation was back in 2022, and around that same time is a kind of a coincident set of data points here that it doesn't surprise you that when we have peak inflation that people are certainly talking about it in earnings reports. So and that has trailed off. We see CPI inflation, as we've talked about, really not continuing its kind of mercuric drop here, but rather remain kind of sticky in this 3% range. And again, like I said, I think that's probably a place that it makes sense that we kind of sit at for a while. And as a result, we have mentions of inflation, which are probably likely to move up. And again, if we have adverse tariff impacts, then for a period of time, it's possible that we have higher inflation, because we'll see in a little bit that the tariffs are beginning to show up in the data in terms of prices that producers have to pay for imported goods. And that's also beginning to translate into prices that are witnessed in the end markets as well. So as it stands here today, CPI inflation ticking up a little bit, mentions of inflation going down, but I think that has the chance of trending up higher, closer to 4%. Now we'll have a couple other transcript mentions, and these are always good because this is essentially AI. In this case, AI is mining transcripts of earnings reports and company pronouncements, talking where management is talking about AI, and when management is talking about productivity. And we've had stronger productivity as of late, and certainly over the last couple of years. And so I think that's clearly manifested in the discussions that are taking place with analysts at the CEO level. And then also AI is coming to the fore. And I think 2025 to 2027 really is going to represent the time in which you're going to see AI find its way into core embedded processes, which are going to in turn help drive more productivity. But at least you can see here that management teams are clearly talking about it more and more and building enthusiasm for this particular trend. Quick check-in on labor. I think we're in good shape in labor. This is National Federation of Independent Businesses. This is their survey on companies that are planning to increase employment. That's actually ticking back up rather nicely here. So you can see typically when you have these little troughs, it represents periods of inflation, which are represented in these gray bars here. We didn't have an inflation, we didn't have a recession, rather, and now we're beginning to see that uptick in employment, expectations here. Hiring transcript mentions have been pretty down. We do know that the labor market is really kind of settled in here. So layoff transcript mentions, I kind of look at both of these in the same light. So not only have people talked less about hiring, they certainly have talked a little bit less about laying off. And here we've got also in that NFIB net percentage of small business employers that are planning to raise worker compensation. So we just looked at the average hourly earnings remaining sticky, and that seems to be a little sticky, although the preponderance of the trend is down. So you've got a declining net percentage of those that are planning to raise worker compensation, which tells me, if labor prices aren't going up, even if they're not coming down real fast, and you've got expectations of increased hiring, and the discussion and the rhetoric around layoffs and hiring has gone down, that we're really at a healthy point in the overall labor market. This is a perspective from the consumer side of things, and this is consumers basically showing an increase in their expectations for fewer jobs available in the overall economy. And I mean, this is notable in the sense that when consumers expect things, they tend to condition their behavior around that. So this could mean that consumers pull in their spending a little bit because if they feel like the job market's not going to be as conducive, even though it seems pretty stable right now, as we just saw on the last slide, that expectations can be a powerful influence. And, this isn't something that's just like beginning to fishtail up. I mean, this is a pretty stark move. Now, oftentimes we've seen very large moves like this in a fairly short period of time. So, not getting carried away, but if this becomes a trend, that would be very interesting to watch as far as like consumer behavior goes. Well, here we have the impact of the 10-year yield, and this 10-year yield is in the blue, and that's basically superimposed with the U.S. Economic Surprise Index here. So the 10-year Treasury yield is actually inverted, and what they're doing here is they're leading it by about 2 months here, and so then you begin to see what this correlation looks like. And so basically Morgan Stanley's uh, thesis here is that elevated rates are having a delayed impact on the economic surprise index. And so, where we've seen the economic surprise index kind of, well, we certainly had a period of time where it was really expanding. We were getting really enthusiastic. Well, if you have higher rates for longer, eventually that's going to weigh on overall economic surprises because, and you think about, the higher interest rates are usually correlated with higher inflation, and we know that inflation's been sticky and so on and so forth. So we've had a decline in the economic surprise index, and that is actually expected to continue if you're a believer in the trend lines that are evident in this chart. All right, so now we have index of consumer sentiment, which you could argue both ways. In the sense that we had an interim trough here, 2022. This data series goes back to 1990, so we've got a lot of history here. You can see the cyclical influence on this. So we did have that trough, and we've actually picked back up. So if you look at the line of best fit on a multi-year trend line basis, it really kind of looks like that. However, the latest set of data points have been down. And so, this gives kind of the critics, a little bit of breathing room to talk about how consumer sentiment might be flagging a little bit. And you can see if this is a trend line, we're at the lower boundary of it and, apt to break that trend line. And just as we saw in that last chart that, expectations are pretty powerful on the part of the consumer and could influence them not only to, in terms of having a more, adverse sentiment, but then that adverse sentiment would likely translate into some type of manifestation into actual spending. Interesting chart here, and something we don't look at a whole lot, but, it's like the different income cohorts here, and, and just looking at excess savings. We haven't talked about that in a while, actually. In the last few charts, we've kind of centered on, what's the health of the consumer and what their expectations are, and are they going to pull in their spending, or are they going to continue on? Well, it looks like here, what's interesting is you've got, top 10% of earners account for half of all spending. That's a powerful statistic when you consider that the top 10% of earners have $1.3 trillion of dry powder worth of spending capability sitting on the sidelines. And as you can see here, after all of the, pandemic checks and stimulus and all of that, that this really hasn't gone away. And we thought it would, but it hasn't. And, there's some reasons for that. Earning has been still relatively strong, and, behavior has been probably a lot more consistent from the consumer side than we thought it would be. But clearly, when you take out the top 10%, you look at the bottom 9%, that cumulative excess savings amount has gone down quite a bit. So, let's just say it this way, that the dry powder of the majority of Americans is a lot less than what it was. I mean, we were talking about this when it was over $1 trillion, and now it's less than 300 billion, which is still obviously a lot of money. But when you're talking about 90% of wage earners, that is, oddly enough, not a whole lot, but it's more than, this is all indexed back to when the pandemic started. So, but it's more than what those folks had before the pandemic. So, very interesting. Top 10% influences a lot of spending power that is honestly still sitting on the sidelines. So, as much as we want to maybe build some anxiety a little bit about where consumer spending is going, we have the comfort of knowing that there's a lot of dry powder on the sidelines. So now we're going to keep talking about some of these like quote unquote mentions and calls and things like that. So these are from earnings transcripts. You can see like pulling forward spending. This is what this is kind of referring to. So like, are you pulling forward your spending for inventory, pulling forward your capital expenditures, pulling forward in hiring? Well, this is just pulling forward on everything. And so, we saw that, pulling forward in 2020, so this is pandemic, people are front running, and then that kind of trailed off slowly, slowly, slowly. And then here 24 kind of picked up and it's really shot up now. And for obvious reasons, the uncertainty with regard to the Trump administration. And I think a lot of people are inventory building in anticipation of tariffs on items that they would import in the future. And then here we can actually see some of this stuff manifested already in the port of LA, in the port of Long Beach. These are inbound containers. And you can see that there's been a huge spike in January data. This is just January data for all these different years. And you can see that, I mean, we're well above where we were in our previous peak, which was 2022, which we all know was highly disrupted. Because of supply chain issues. But this is, I think, one of the clearest indications we have thus far of what people are trying to do in response to the proposed tariffs that are on the table now. Supply chain index is also important in terms of the multinational trade items, and again, this whole transition and how companies are going to react to tariffs if they come, because it seems like you've got both sides of the aisle that tend to support these types of barriers to trade. I mean, I'm not a tariff guy, so to speak. I prefer to have free trade if it truly is free. But we do see supply chain index moving lower. Again, not anything that happened yesterday, but it is still higher than it has been for the majority of the last couple of decades. On this chart, we measure what the impact of tariffs and the DOGE savings expectations might have on inflation. And you can see here that we have a trend line of quarterly impacts that extends out into 2027. You can see the green bars are inflation expectations, which would obviously increase the inflation expectation overall. And then offsetting that, you've got exchange rate and fiscal deficit issues. But you can see that overall, the sum of the total shocks and the peak impact in the fourth quarter of this year is on the order of about 0.2% on a quarterly basis. So obviously these are in isolation. So that's 0.2% in fourth quarter, and then probably about another 1.5% in the first quarter of 26, and moving down to 0.1% in the second quarter of 2026. So you can see that these are quarterly impacts that peak in the fourth quarter of this year and decline over time. So in a similar vein, we want to measure the impact of tariffs and the expected savings from the DOGE efforts on GDP, on economic growth. Again, some of the similar impacts here, we've got inflation expectations, exchange rate, and fiscal deficit. Again, the trough in GDP, or I guess I should say the peak in the impact to GDP is clearly felt here in the fourth quarter by these estimates. This is Apollo again. So with increasing negative impacts on GDP from this first quarter here throughout the remainder of the year, and so basically about 0.5% would be the kind of the quarterly impact in the fourth quarter, and then it decreases and intensity thereafter to a point where we get into the latter part of 2027, it becomes much less of an issue. Okay, we have risks to the upside on PCE inflation. We've talked about this. You've seen this chart before, but these are the regional Fed surveys, and you can see here that some of these have witnessed a kind of a notable uptick. Not that we would get immediately worried about all of that, but we want to watch this data series for probably another couple of months before we get really worked up over this. On this slide, we have consumer confidence data that is specifically related to inflation expectations, and you can see that that has clearly moved higher. Again, this is tariffs. This is a lot of the rhetoric that consumers are listening to in the mainstream media these days. So I think we need to put a little bit of perspective on tariffs and some of maybe what the administration is doing. We've got tariff revenue as a share of federal receipts, and that number is really not that big. I mean, this is ridiculously long time ago, dealing back like prior centuries almost. But lately, that number's been very low. This is data that comes to us by way of First Trust. Accumulated from other sources here, Census Bureau, and then custom duties, federal receipts. This is from the OMB, Office of Management and Budget, and you can see that we've had a little bit of leveling off after kind of a peak in 2022. So, and this sets about $100 billion. And then the whole notion of what some people are talking about is like, oh well, there's a goal that we're going to replace income taxes with tariffs, and the reality is, you've got a large tax revenue deal. Here's individual income taxes as a percent of the total tax revenue, pretty high percentage there. And then what you could get off custom taxes, or what you're getting off right now, is like doesn't even move the needle relative to individual income taxes. So that the whole notion of that happening is actually fairly low. Okay, probability of recession is still pretty low on balance. So here's 30% right here. You can see that some of these surveys are like ticking up slightly, but it's not at a level that back in 2022 we were almost depending on what country and what measure. Green is in the UK. That was a very high prediction. US here in the amber. We got up to about 60, 65, and then kind of held there for a while, and then went down, and you could see that little fish tail up. But I think the bigger risk is probably something that feels and looks a little bit more like stagflation, where we have higher rates of inflation than would otherwise be desired, but we really just don't have like a tremendous amount of growth to go along with it. That's not necessarily what the analysts are looking for right now, but I think that's a greater risk versus an outright recession. Interesting chart here on mortgages, and we talk a lot about affordability, and Apollo has actually done a lot of work in the housing sector and kind of they're doing their analysis. But we've mentioned this a few times, but if you are in a house and you have a mortgage less than 4%, you're obviously immediately disincentivized to wanting to move unless you have to for work, or or you're downsizing or whatnot. But you can see here now with the 30-year conventional financing rates moving higher, moving in, depending on what day you're looking at, it could be, mid 6% level, or it could be over 7%. And we almost touched 8% at one point. But you can see that this is a very odd and unusual disconnect here between the effective rates on mortgage debt outstanding. And that's because people are holding on to these mortgages that are below 4%, and it's causing that average to really fall and be disconnected with the trend line in actual mortgage rates. So continuing the thoughts on the housing sector, done a lot of work in this area, and you can see that our trend line is in this light, call it gray here, and the household formation numbers have really fallen behind since the pandemic. And we know a lot of this from a demographic standpoint. Younger generations tend to live with their parents a little bit longer, and there's a lot of different things. But the bottom line here, and this is what Apollo is making the case for, is that we have a total housing inventory deficit of like $2.4 million homes by virtue of this household formation versus trend, which is also represented here. And the sum of that is a national deficit of well over 2 million homes. Here we have a number of unsold completed homes. So this is very, very interesting. So this kind of speaks a little bit to the ability for some people to get finance, because as you just saw, we're underbuilt in homes, but we do know that costs have gone up, and the cost of production have gone up, prices have gone up, prices have been, I'd say somewhat stable, but that's relative depending on what market you're in. Now, like say, here in the Austin metro area, prices have come down a little bit, but they may be going back up. But clearly in this chart, which is derived from Census Bureau data, that we've had a continuous uptick in unsold completed homes for sale. Okay, we've got some economic data here, at least more economic data. This is durable goods. X transportation, so it's kind of a smoothing figure, and you can see here estimate was for 0.3%. We got 0, so that was a bit of a disappointment. So really not much momentum on the durable goods side. If we transition, however, over to capital goods, X aircraft and parts, this is very important, and also excluding defense, that number was actually very, very strong, like 0.8% versus 0.3%. You could see that represented right there. So, obviously those two, this metric is clearly moving in the direction that we wanted to. This one seems to be stagnant, and as you can see here, it's had really moments of activity surrounded by long periods of stagnation. Okay, now we've got some regional Fed survey data, and I think this is all very interesting because we talked about manufacturing kind of coming out of its prolonged slump and trying to get its head above water. Well, it's obviously not happening in the Kansas City sector, so the manufacturing index remains below the break-even side, so this represents contraction. Also on the production side, we've had a tick down in things over a while. And so, again, thinking about the tariffs and what that could mean, you've got new orders for exports, and that's looking trending down. The blue represents what's going on right now, and the pink represents what is expected in about a half year from now. And you can see that both of those have recently started trending lower. So now we have Richmond Fed and the Dallas Fed. You can see here, Richmond Fed, the manufacturing index is now positive, and the results there were a lot better than estimates were looking for. Manufacturing new orders did not grow; they were 0, but that represents an improvement over where we have been on manufacturing for a long time. So again, every region is different, and so it's important to understand, what region you're in, which in our case is the Dallas region. You can see manufacturing took a notable step back. Outlook uncertainty, which is kind of an interesting barometer, that definitely witnessed a leg up. So again, we'll want to monitor these on a monthly basis to kind of gain an understanding of, is this kind of, are these head fakes, or do these kinds of stats have real staying power given the uncertainty in the backdrop? All right, Kansas City Fed, we've got prices paid. I alluded to this chart earlier. We've got the same data for the Dallas Fed here too, but this is what people are paying for raw materials, and that number is clearly going up. You can see that very, very intently. So not only do you have it going on a current basis, but your expectations level is pretty strong too. And so that's Kansas City. You go to Dallas, and you got prices paid for raw materials, and it's also moving higher off of its kind of like interim base, if you will. And as a result here, expected prices paid for raw materials, again, moving notably higher again on these fears. Two final comments here on the regional surveys. We've got Kansas City and Dallas Fed, and this is for prices received on finished product. And you can see here in both cases, the current, you've got a little bit of an uptick in both of these, and certainly in expectations in 6 months, you've got a distinctive move higher. And so this is really the data that we have now that tells us how things are going to react to tariffs. And so, the idea is that, or the reality is that you're beginning to see survey respondents into these regional surveys say that they're taking product in at higher prices, and they're now beginning to pass them out or pass them along when they complete that or finish that product and sell it in their channels. So how does all this play out in the investment markets? And so we'll start with the bond market here. You've got government yields moving lower. In this case, this is the 2-year government bond yield moving from about 25 basis points, 30 basis points down to 4.30 to about 4%. And also on the 10-year treasury here, we've got rates that you can see here moving down from 4.8 to 4.2. After having, from the fall, troughing out well below 4% and then moving consistently higher since then. So this represents, some of these fears that are embedded in the market. And obviously, the equity markets have been a little bit more volatile, and, the S&P is actually down for the year on the basis, or very close to break even for the year. On the basis of this uncertainty over everything that we've talked about, tariffs and so on and so forth. But there are a lot of good things going on in the economy that at least have not yet been disturbed by fiscal policy. But clearly the expectation in the bond market, which is something we always want to pay attention to, is important because those rates are moving lower on the expectation of some potential for slowing of growth. And we see here that after this long slog, actually this whole long slog here of rate inversion between the 3-month Treasury and the 10-year Treasury, we got back into positive territory here over the last several months. And unfortunately, with some of these moves, we've seen that go inverted once again. So this chart with data from Morgan Stanley and Bloomberg represents the degree to which the S&P 500 and the Russell 2000 are correlated with the 10-year Treasury yield. And you can see the blue represents the S&P 500, and they have been negatively correlated. Those index values and those trends have been negatively correlated with bonds, which is what you want overall over a long period of time. Although this is not a long period of time, you want to see negative correlation between stocks and bonds, because that's how you get your diversification and your risk mitigation. So we just witnessed a trend back into positive territory for positive correlation between the S&P 500 and the 10-year Treasury. So not necessarily something that we want, but as we've said for a long time, I think, the 60-40 portfolio, so to speak, is absolutely not dead. You just have to think about fixed income, and you have to think about equities a little differently than you historically have been. Correlations are still improving on the Russell 2000 side. You can see there is a fair amount of overlap here, but we clearly haven't seen that correlation pop positive here yet on that particular index. On this chart, we have the S&P 500 equal weight versus the cap weighted relative performance. You can see that is eroding, continues to erode here. So, again, this is relative to, relative performance. And we do know that cap weighted, with its concentration in technology stocks, has been a very strong influence on all this, because some of the largest companies in the S&P 500 are very much influenced by factors which are driving multiples up considerably and valuations up considerably, and that's happening at the expense of a lot of the other, call them 490 stocks in the S&P 500, which there's not a tremendous amount of unanimity between them. We got a lot of those stocks in the S&P 500 that are going the other way than some of these Mag 7 stocks. This chart that we're looking at here represents a plot of forward PE to long-term EPS growth, and so it's a measure of the relative valuation of some of these geographical sectors, and basically, what we want to see. We certainly want to see a lot of long-term growth, which we actually have in the S&P 500. Current estimates have come down a bit, but they're still looking about 12.5%, 12%, if you will. But valuations are still pretty high. And so what you really want is somebody down in this particular quadrant that's cheap but has great earnings potential. Well, guess what? We don't have that right now. But what we do have are some of these other areas like the MSCI ex-Asia, which actually does have some U.S. in it, but China, which has had probably been ironically one of the better performing stock markets this year thus far, and you've got Europe, UK, France, Japan, that while they don't sport the long-term earnings growth that the U.S. market does, they still are much cheaper, and so that's a little bit of a trade-off. If you're accepting long-term, earnings growth that are somewhere in between, like call it 8 to 11%, as opposed to 12% for the U.S., but you're getting them a lot cheaper. The only issue is, are you buying them without a real catalyst for that value differential to be realized? And oddly enough, with all these countries in here, we see this one, small caps, and so. Been a fan of having an allocation of small caps. Again, you're not getting quite the same level of earnings juice, but they are, from a price to earnings ratio standpoint, significantly cheaper than what we see in the S&P 500. So the S&P 500 index does have a lot of things going for it. Now, notwithstanding the fact that there's a high degree of concentration amongst the top 10 firms, you see here that you've got net margins on a next 12 months basis continues to move higher. This is a consensus number from Morgan Stanley research. Hard to predict, but they're expecting those trends to continue. So higher profitability over time on the part of the S&P 500. Now, as a follow-on to that, we look at the relative differentials between the U.S. and the rest of the world. Now, we did tell you a couple charts ago that valuations were a lot cheaper. You're not getting the same level of earnings growth. We can see here that here's the EBIT margin, which is earnings before interest and taxes. You can see those margins much, much higher for the S&P 500, and as they have continued to improve, much higher than Europe, emerging markets, or Japan. And then the return on equity for these particular indices, we've got 14.5% for the S&P 500, which is a pretty stellar number in its own right. And then again, not that there are any slouches, but 12.7, 13.1% here for Europe and emerging markets, and then Japan kind of pulling in the rear, so to speak. So in this chart, we've got the American Association of Individual Investors, AAII, bull-bear spread, and we can see that that has dropped off considerably. You've got bearish readings, which are showing interim peaks, and again, probably as much as we've seen in at least 10 years on this data series, with the exception of 2022, which is similarly the same time we saw this level of decrease in bullishness. So market on the part of individual investors is rather bearish at the moment. This is putting a lot of pressure on stocks overall, and why sometimes when they start off in the green in the morning and they just can't hold those gains and they wind up selling out at the end. There's just I think there's just a lot of people waiting on the sidelines. The last chart in the chart pack this week is really an interesting summary we've heard a lot about in the last week about President Zelensky's visit to the White House, which did not go well, unfortunately. And the comments made about Europe having to step up and fill the void because the U.S. is not going to help Ukraine. And then now Europe is really rethinking the whole NATO structure and its own security apparatus. And you can see here that as we conclude the chart pack this week, that you've got in just about every major European country that you have expectations for a rapid increase in military spending in the years to come. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week. We'll talk to you again soon.